This is the Pimp Trader. Let's review what happened last week. On Monday, the market fell off more than it did previous 3 days of last week. Yet it found support. It opened low and it fell lower, but it rallied up. So it bounced up above support. Then on the following day, on Tuesday, the market gapped up a little and then it fell down. So at the beginning of Tuesday in the morning, we shared a post about buying the bounce after the dips. We shared this was an opportunity on Tuesday to buy because the market found support and it bounced up on Monday and on Tuesday. So let's explain this on the chart. On Thursday of last week, the market gapped down. On Friday, the market gapped down. And then on Monday morning, you see here of the opening price, it opened on a gap down, but then it bounced up and it tried to exceed the high of Friday. And then on Tuesday morning, the top here of the red candle bar shows the open and it gapped up. Well, not a gap up, but it opened up. And that is a sign that the market is trying to recover. That's why I shared a post about buying the bounce after the dip. Tuesday did finish lower within the range of the green candle of Monday. On Wednesday, the market did start off lower than the close, but as you may have been aware, the tariffs were put on a hold and the market rallied significantly higher than the open on Tuesday. On Thursday, the market opened lower about halfway through the price range of the Wednesday move. Then on early Wednesday morning, we shared another post called Buying the Dip After the Bounce. We have shown throughout many of the charts we have reviewed at the Pimp Trader how when a stock price moves up rapidly, could be on earnings, could be on news, it could be over a week, but there's a really sharp move within a very short time. What tends to happen is it'll find resistance, or there's the number of buyers are kind of run out and there's people that are holding that have been looking for an opportunity to sell, and then the price dips. This can present a buying opportunity. The majority of time I have noticed it will drop a little bit, hold a price, and then start rallying up. And then on Friday we had a good finish. It finished higher than the Thursday price. So overall on the week we started very low and finished higher. On the weekly chart, there's a lot of work to be done. We see the 50-day moving average, or in this view, the 10-week moving average, is still sloping down significantly. We undercut the lows of January. We've undercut the lows of August of last year. And we've undercut the lows of April of last year. The price seems to have found support at the high of December of 2023. Although this was a good week, there's still a lot of work to be done. Like I mentioned in the post when reviewing the chart in mid-March, I mentioned that if the price falls below the support line, we will see more downside, and this is what happened. Wednesday on the big rally, the price found resistance at the last low. Since we are officially entered bear market territory with the sell-off on Thursday, Friday, and Monday, we need to be cautious that the price does not fall below this new support line. If it does, we can see potentially more downside. From my observations, the market tends to have at least 3 counter trend rallies before the price starts to recover and the market starts showing more bullish momentum. So far we have 1 counter trend rally. This week's could potentially be a counter trend rally. So there's some work to be done. We want to see the price get above the last low. We want to see the price get above the 50-day moving average. We want to see the price get above the 200-day moving average. We want the 200-day moving average not to slope downward, and we want to see the 50-day moving average start to flatten out instead of curving down and start to slope upward. And of course, we do not want to see the price fall below this recent support line. So that was the review of the S&P 500. Let's review the NASDAQ 100. We have similar behavior here. Price found support on Monday. We had the same rallies and bounces and dips on the days that the S&P had them. We are seeing the price find resistance at the last support line. We're still seeing the 50-day moving average moving downward. The 200-day is still relatively flat, but is showing a slight curve down. So the recommendations and observations shared for the S&P 500 also apply to the NASDAQ 100. Now let's review the Dow Jones Industrial Average. Again, very same story. We're seeing very much significant behavior across these three major indices. Now let's review the Russell 2000. These are the small caps. This one has been in a downtrend since December of last year and is showing different behavior than the three major indices. We kind of see one counter trend rally that took about a month that ended in early February. Price fell. It had a very short counter trend rally that ended in late March, and now the price has fallen sharply like the other indices and had very similar price moves but not as strong. Given the magnitude of this price change, I would not quite call it a counter trend rally just yet. This one is an avoid if you're not in it. If you are in it, we may have found a support line. This one has way more work to be done. As you see, the last low, the last support line, the price never even got close like it did with the other indices. The 50-day moving average has been curving down for a while now. Fortunately, the 200-day is still somewhat flat, but it looks like it's starting to curve down. We want to see the price get above the last low. We want to see the price get above the 200-day. We want to see the price get above the 50-day and the line to start flattening out and curve upward. These will be the signs that the small caps are ready to have bullish behavior and get out of this bear market downtrend. The S&P Mid-Cap 400 showed much more strength than the small caps. The rally on Wednesday did get closer to the last support line. Unfortunately, it has been in a downtrend since December like the mid-caps. This one has the same recommendations and observations as the small caps, yet this one tends to show a little more potential because the price moves were stronger than the small caps. Gold has been very strong. It gave us an opportunity to buy at the bottom of the chase zone on Monday. Tuesday, it gave us another chance because it stayed inside the bar of Monday. And if we didn't buy on those days, Wednesday it took off. Thursday didn't even have a dip. And Friday it gapped up. So I had three gap ups in a row after Monday and Tuesday. That was the last chance to buy. Now it's in the hold zone. The hold zone is above the chase zone. Hold is an avoid to buy because the buy zone is the most optimal time to buy. The chase zone is your last chance. The hold zone, it's overextended. Next, we will cover silver. Silver has not been as strong as gold, yet it has given us an opportunity. It sold off hard like gold, but on Wednesday, Thursday, and Friday had really strong moving price days. The price is still below the buy zone, which gives us a chance to buy. Unlike gold, where we had a very small window, silver, we still have opportunity. It was looking strong within the buy zone before the sell-off. Now we may have a second chance to buy at the optimal buy zone price. Aggressive investors may choose to buy already. That's really on your risk tolerance. For an aggressive investor, when the price went above and stayed above the 200-day and gapped up the next day, an aggressive investor would see that as a great opportunity to get in. More conservative investors will wait for the 50-day. Berkshire Hathaway was really strong. It was the last of these tickers that I review that fell. It only fell hard on red candle on Friday. On Monday it fell hard too, but it rallied and almost closed the gap. The thin part of the candle did close the gap, but the thick part did not. This gave us an opportunity to get in on Tuesday, Wednesday, Thursday. Friday was the last chance since it opened below the top of the chase zone, but it ended above it. Just like gold, if you didn't catch it, I would recommend waiting until the next buy opportunity because the hold zone, it tends to be extended. For more aggressive investors, you may see the top, the last high, and the current price as your gap or your price window to get in. And that's it for this week. This is the Pim Trader.